is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, and welcome back to another episode of DeFi Decoded. This is Alex Tapscott coming to you live from Chicago, the Windy City, here with Andrew Young. Andrew, we're back, baby. Like we never left. All of a sudden, risk assets are pumping like crazy. Crypto is no exception. There seems to be a lot of different catalysts here that are pushing this rally higher, things that are unique to the asset class, but also just trends in the general market, which seem to be putting a bid under equities, under coins, you name it. So let's make sense of the macro picture first, and then we can drill down on the crypto story. Go for it.
Yeah, I mean, we've been talking about this for, I guess, almost 6 months now. There's kind of like the three Horsemen catalysts coming up, mostly in Q1. And I think what's happening right now is just the market's starting to wake up to that and starting to front run it a little bit. So just to recap, the three huge catalysts that in my head are essentially pre-programmed is the BTC ETF, number one, the Bitcoin halving, and then finally, what looks like sort of the end of the rate hiking cycle.
Yeah.
And so it looks like number one and number three have sort of sharply come into focus in the last couple of weeks. Obviously, the Bitcoin ETF still moving along. It now looks like it's going to come, like the sort of expected date is first week of January, because there is essentially a comment period where the SEC could effectively approve all the issuers' Bitcoin ETFs at the same time. And most ETF analysts think the SEC will do that just to essentially avoid playing kingmaker and allowing one issuer to have kind of a head start.
Right.
And so that's kind of like the target date that everyone's expecting, which is obviously very soon. That's literally 6 weeks away. At the same time, we're also starting to see quite a bit of softening in the sort of macro environment. So CPI yesterday came in below expectations, month over month change of 0% essentially.
Yeah.
And headline inflation rate down to 3.2, which is a lot closer to 2% than where it was even just a couple months ago when it was kind of hovering close to 4.
Hard to imagine even a year ago, 9%, right? When the big print came out and this whole cycle started. So incredible, the progress that's been made, honestly.
Yeah. And most importantly, because we actually hit 3.2% headline rate back in July, I believe. Yeah. But at the time, core inflation was hovering close to 5. And so you could kind of sort of foresee that it would start to bounce back. Now core is is actually exactly at 4%. And you're starting to see a lot of softening in shelter. Without going too much into the sort of the macro side, but it does seem like we are, and I believe now the market is expecting the first rate hike in May.
First rate cut. Yes, yeah. First rate cut.
Yeah. And it's only expecting 12.5 basis points increase from here, which essentially effectively means like a 50% chance of one more rate hike.
Yeah, I'm shocked that it even is pricing that. And I saw that the swaps market were basically pricing in a hike in December went from like 20% to 0. So I don't know when this hike is supposed to happen, but I mean, I think that we're over the hill as far as that theme is concerned. And like markets are forward looking, and all of the metrics show that the percentage of assets held in cash, money market instruments, and so forth has just been soaring this year. It's so ironic in a way because, Ray Dalio, who I think probably made a better investor than Pundit, said cash is trash like exactly a year and a half ago. But actually, it's been the only thing that people have wanted to own, because why wouldn't you want to earn 5% risk-free? But now, if the rates are going down and all of a sudden, for people who don't know, that's very good for bonds. That's very good for equities. And I guess it's good for coins too. And I wanted to dig in on the crypto side of things a little bit here, because we've seen Bitcoin and slowly the rest of the asset class really start to move higher in the last couple of months. Now, we could argue that Bitcoin traders are seeing something that others don't and front running the CPI print because they're macro geniuses. But it's really more the ETF news, right? That's pushed the prices higher here. And it doesn't seem to matter that there are delays or that this thing actually hasn't even come to fruition. It's clearly the thing that's putting a bid under the market. And what's most fascinating to me is that, Bitcoin at 25,000 muddling along, if an ETF had been approved like this, like out of the blue, then I'm not sure what the flows would look like. But at $35,000 and everyone like piling in trying to get ahead of this trade, I think that it's almost like a self-fulfilling prophecy in a way. It's like, who's going to buy the ETF? It's going to be a lot of advisors. People are talking about the institutions. An ETF like this is a product that's very well suited to advisors and advisors and clients, which are typically like upper middle income people, retirees, stuff like that. People with $1 million to invest in the market or $2 million or whatever it might be. And those people are probably looking at the price of this asset and saying, hey, the thesis seems to be playing out. And it certainly doesn't hurt that Larry Fink and others are telling me that this thing is an investment that should be a part of a diversified portfolio. And then all of a sudden you're going to see like it's almost like self-actualizing or self-fulfilling prophecy. And then all of a sudden it's going to actually create a lot of fund flows. I don't know. It feels like very reminiscent, frankly, of what we saw in the winter of 2021, right?
Yeah.
When Bitcoin was like the leader and a lot of the other assets weren't moving. And that time, I don't know what the catalysts were. I mean, you could make the case that even like the fact that Canadian trusts and ETFs were in the queue and getting approved actually helped to kickstart a bull market, or was certainly a part of that. But now we've got that on an order of magnitude that is 10, 15, however many times larger, because we're talking about a product that US investors can easily buy. US investors can easily buy Canadian products, but only up to a certain point. Half the AUM need to belong to Canadian investors. So there's sort of like a ceiling. And now we've got this thing that anybody can own. So yeah, I mean, I think we've been talking about it. Like this is shouldn't be news to anybody who's joined the DeFi Decoded podcast. But if you're a new listener, these are the things that we've been watching for. And it's nice to see them coming to fruition. Now, we also but fundamentals, right? Not just prices, but, the prices sometimes lead the fundamentals in an asset class like this.
Yeah, just to jump in real quick, what's also been interesting is this is playing out almost exactly how every other crypto market plays out, in the sense that Bitcoin dominance, which is essentially the relative market share of Bitcoin relative to the whole crypto market cap.
Yeah.
It's up from 36% to just over 50%, I believe, last time I checked.
Yeah.
So on like a relative scale, it's up almost 40% from 36 to 50 essentially. And that's actually really interesting. And what we're starting to see right now is Bitcoin's gone that sort of initial increase, and now we're starting to see a little bit of a trickle down into other cryptocurrencies, most notably Solana.
Yeah.
Solana is just kind of like a rocket right now, because mostly people are just realizing that the sort of the FTX overhang, as people call it, is mostly played out. It actually looks like FTX has been the FTX estate through which essentially has contracted Mike Novogratz from Galaxy to sell down their SOL position, has been dumping SOL this whole sort of rise up, which has been effectively cleaning out the overhang of that sort of forced sale. It's just kind of like we've talked about this actually a lot as well on the podcast, about how SOL has actually quite a strong underlying dev community that can build applications that can't exist on Ethereum or even other L2s, just because of the sort of speed and scalability advantages. And it's just been interesting to see. I think the one sort of crypto that coin, whatever you want to call it, that I'm watching really closely right now is Ether. I think Ether is in store for a massive sort of catch up pump, whatever you want to call it.
Right.
Just because it's on a relative scale, it's underperformed both Bitcoin and SOL, which is kind of like effectively its biggest competitor. And it's still just printing money and actually distributing that money to holders of the coin through staking rewards and burn. And so I think it's fundamentally the strongest, and I would say sort of fundamentally the most undervalued. And then on top of that, you also have this very easy sort of catalyst and narrative, which is, there's already Ether futures, therefore there's no real reason why there shouldn't be, an Ethereum ETF coming up right after a Bitcoin ETF. And so I think I've been sort of hearing this a lot on crypto Twitter, and I kind of agree. I actually think Ether will be the biggest beneficiary of a Bitcoin ETF because as soon as the Bitcoin ETF comes out, all focus will shift to Ethereum as the sort of next target. And then that just combined with its sort of relative underperformance and strong fundamentals makes me think it's kind of it's probably one of the most attractive sort of blue chip crypto assets at the moment.
Well, you may have been reading this on crypto Twitter. You may have been reading it in CoinDesk 2 months ago when I wrote an op-ed saying that the biggest beneficiary of the Bitcoin ETF would be Ether. And actually mentioned.
I thought I came up with that.
No, you didn't. October 12th or October 7th, 2023. I was actually talking mostly, like obviously ETH itself is a beneficiary, but also I was talking a little bit about the Grayscale Ethereum Trust because. Like why would Ethereum be a beneficiary? Well, one, like the price of Bitcoin going up creates a wealth effect, which cycles into Ethereum. But the more interesting thing is that once a Bitcoin ETF is approved, I'm not aware of any reason why an Ether ETF wouldn't also be approved shortly thereafter. It has the market has all the same characteristics as Bitcoin does. It's large, it's pretty liquid, and it has a regulated futures product that trades on the CME that does tons of volume, which is critical to launching an ETF. That was a condition for the OSC in Canada, and that'll be a condition probably for the SEC as well. Which is why, by the way, people are talking about, there'll be ETFs for XRP and SOL and everything. Well, until there's a regulated market on the future side, like that's probably not going to happen. That market might get built. CME is doing lots of cool stuff, but right now that doesn't exist. And I was looking at the Ethereum, Grayscale Ethereum Trust discount at the time, and it was like 35%, right? And I think the Bitcoin ETF or the Bitcoin Trust was like 25%. Since then, the Bitcoin Trust spread has narrowed. That's the discount to NAV, right? That's being handicapped because until it's an ETF, you can't redeem your units at NAV. Moved up 10%, right, on Bitcoin, but with Ethereum, it moved up 15% or more. So actually, you're getting the double whammy benefit of the price going up, but also the discount narrowing as well. It's not investment advice. I'm not suggesting anyone buy this thing, but it's just interesting to see that dynamic play out because once that like if you're correct, Andrew, and everything gets approved at once, probably that'll also mean the Grayscale conversion from GBTC to an ETF will also get approved. And in so doing, will pave the way for Ethereum. And Grayscale's actually said that they formally said that they will convert that Ethereum ETF trust as well. So anyway, I'm with you. I think that it's one of those scenarios where Ethereum is probably like the most hated asset. Not literally, like people, like everybody uses it. It's the platform that most all major enterprises go first when they're trying to do something interesting. Like it's clearly a dominant, impressive piece of technology. But from a purely investment perspective, everyone's like, okay, well, Bitcoin is a bellwether. You can own that. That'll be what the advisors and the retail investors buy. But where's the real money to be made in the next bull market, right? I think that's how a lot of people think. And they're looking at, while Ethereum goes from $1,800 to $5,000, that would be great. But like, what could Solana do? Maybe it'll go from 30 to 300 or something like that, right? And I just think that, that's human nature. People are going to speculate and try and chase winners and so forth. But I think you're right that like on the fundamentals and on the flows, and on the ETF side, I think Ethereum is really like nicely positioned, right? And I think that it's one of those names that at least today is being overlooked because people are trying to either own the brand name Bitcoin or chase the big potential gainers.
Yeah, and I think just looking back, even since the merge, if Ether was to get back to its relative price to Bitcoin from when the merge happened, which was last summer, that would put Ether at about 2,800 or $3,000. So that's kind of like where I think it should at least get into kind of like the $2,500 to $3,000 range, even if sort of Bitcoin doesn't move.
It may. We can't.
It may. Yeah. Of course. It may.
I mean, anything can happen.
Yeah, of course.
Yeah. Like obviously we're not speculating on the outcomes here. We're just like musing.
Yeah, I just that's what I think. Like from a fundamental sort of perspective, it should sort of trade at. Obviously, who knows what happens with the market? I think you're right. Ether's in this weird position where, exactly like you said, Bitcoin is the, kind of like the lower beta, more liquid blue chip coin, and then Sol is obviously like the higher beta, more torque in a bull market. Whereas Ethereum is sort of this kind of weird middle ground. It's probably closer to maybe to Bitcoin than Sol, but at this point, but it's it's just kind of chugging along. It doesn't have the same liquidity that Bitcoin does, but doesn't have the same sort of high beta torque that you want in a bull market. And so it's definitely one of the most hated coins right now. I'm seeing a lot of stuff, a lot of people sort of taking victory laps on Sol right now, which makes me think that Ether's probably due for a catch up, just because when everyone's saying one thing, it typically goes the opposite. That's what we've seen, at least in crypto.
Yeah. Well, and also like in the long run, I mean, not it's a cliche, obviously, but in the short run, the market is a voting machine, and in the long run, it's a weighing machine, right? Like Warren Buffett said that. And so right now, it's like, yeah, people are going to chase narratives, and they're going to say, one thing looks undervalued, and we're going to get in there, and because you can only build on Solana or whatever the theme is. But eventually, like the fundamentals will win out, and I'm not suggesting that that's bad for Solana. Like Solana might have great fundamentals, but I think ultimately, look, we're in a period where the market's ripping and everyone's excited about price and so forth. But like we do prefer to talk about the fundamentals here. So I think that's like dig beneath the surface and tell us what's going on.
Yeah, and one thing I also just want to sort of shout out, it looks like 3iQ got a staking ETF approved, which is pretty cool to see. So 3iQ is a Canadian ETF issuer. I'm kind of curious what you think of that, and do you think that's something that could be launched in the US as well, or is that a couple iterations away? Because I thought that was pretty cool.
Admittedly, I haven't looked into it, so I don't know the details. Do you know? Are they staking all their ETH? Because that I don't see how that's possible, because ETFs are redeemable at any point in time, and so you can't, if you have all your ETH staked, you can't meet a redemption, right? Because you can't sell it if it's staked, right? So I'm guessing it's a portion of it, or is it in their trust? I don't know. I actually don't know the answer to that.
So I think what it is so they keep their ETH custodied with Coinbase. Coinbase is like institutional custody platform.
Yeah.
And I believe what they do is they essentially stake it through the Coinbase custody platform. And the staking yield right now is like roughly, I don't know, 4 to 5%. And essentially, I'm actually curious to see, like, I guess, what they do, and it looks like they're paying pretty high fee, actually, 25% fee, 25% fee to 3iQ. So it's a pretty good business model. That's actually, I haven't seen something that high. I mean, that's great for them. It actually doesn't specify how it works. I'm wondering if, because you can redeem staked ETH if they use, for example, Lido, but it doesn't actually look like that's what they're using. It's actually interesting. They actually provide very little information on how the staking works. I guess if they're using Coinbase, though, Coinbase can essentially provide liquidity and almost act as like the redemption service.
Yeah, exactly. I mean, like if Coinbase is getting 25%, then they're probably offering them like margin, right? Like liquidity to meet redemption.
Yeah, that makes a lot of sense, actually.
You're giving a quarter of your whole yield.
Yeah, that's wild. I mean, it's a great bit. I mean, it's just an extra 1%. If the yield's 4%, right? So they're taking 25% of the 4. That's a 1% sort of, essentially 1% annual fee on all AUM. So they have a couple $100 million. That's a pretty nice fee.
Yeah, not bad. What's the read through there? That maybe Coinbase is the better investment.
Yeah, I mean, I don't know. Do you want to talk about Coinbase at all? Like, Coinbase has been I think Coinbase has been sort of catching up a little bit, but to me, Coinbase is kind of like Ether in the sense that it's maybe due for a catch up, just from the perspective of the fact that like traditional sort of non-crypto native investors are maybe a little bit slower to seeing what's happening in the crypto ecosystem itself. We've sort of seen this in the past with Bitcoin miners, where they sort of underperform Bitcoin at the start of the cycle and then massively outperform as mainstream consensus kind of catches up to what's going on in crypto. I think one thing that's also interesting is Base has, which is Coinbase's L2, has really, really taken off. It's actually one of the biggest L2s now in the world. I think probably top 5, maybe even top 3 by users. And when Base was kind of taking off, Coinbase, the stock, wasn't doing much. So I'm kind of curious what you think of just Coinbase, I guess, as a company and sort of that sort of this like life cycle that we see where spot crypto tends to kind of move first, and then the publicly traded crypto equities sort of follow after.
Well, Coinbase didn't exist as a public company in the last bull run. So we don't have the precedent the way we did with like the miners, for example. And also the miners, the dynamics have changed as well, because the mining is more difficult and the rewards are about to shrink, right? So, but putting that aside, like on the Coinbase side of things, I mean, this is public knowledge. Like, it's the largest holding, single equity holding in the Web3 Innovators Fund, the 9-point Web3 fund. We think it's an incredible business. The company has got by far the most US users of any platform, and it's really not even close. They've got a huge venture portfolio of holdings that I think are not reflected at all in the value of the company. And they've got a layer 2 that could earn the similar kinds of like economics as any other layer 2 if it's used like widely on the network. And I think that there's just so much excess capacity in that company to take advantage in the next bull market, whether it's from retail trading or staking or custody on behalf of all these ETF providers. Like, look at the filings for all of the ETF issuers, whether it's BlackRock or any other. You'll see Coinbase a lot. So for lots of reasons, I think the company is very well positioned for the next cycle, not just because of retail speculation in crypto, but because of technology platform they're building, because of the portfolio that they own, and because of their pole position in the institutional market, which I think is frankly unrivaled. And I think that honestly, like there is some regulatory overhang. I mean, let's not forget the SEC sued them this summer. And I think that that's probably the main reason why some people prefer not to touch it, because they want resolution on that issue before they get around to investing in it. But like risk and reward are two sides of the same coin. So I think that like from our perspective, we're comfortable with that risk, knowing all the positives that are stacked in its favor. And I mean, like I think Coinbase is like, why right now it's $90, I mean, it IPO'd at over 300 in a different kind of market. And since then, the business has gotten better. So I don't know where it goes from here, but I just think like, if you're looking for a company in the public market that's a proxy, I think Coinbase has a lot in its favor, right? And we really like it.
Yeah, no, I think that makes a lot of sense. I didn't realize Coinbase was sort of your guys' biggest holding. That's really cool to see.
Well, our biggest holdings, and this is again in a public filing, are Coinbase, Bitcoin, and Ether.
Perfect. It's like 3 blue chips. I think
we're kind of big on the blue chips. We have some of the miners, and you're kind of right that like the Bitcoin price has moved. The miners haven't really moved a lot, and they are kind of a beta play, but it's sort of like it's very similar to commodities in a sense, right? Which is that like mining companies in the real world that like pull stuff out of the ground have a cost of doing that. And if the cost of doing that is at or above the price of the thing that they're pulling out of the ground, they're going to lose money. But if the price of the thing that they're pulling out of the ground keeps going up, then they're operating leverage. They're operating like leverage can increase dramatically, right? So if like the price of gold is $1,000 and your costs are $1,000, then or like let's say your costs are $999, then you're making $1 for every ounce of gold you pull out of the ground. But if the price goes up to 1,100, you're making $101. So your profit is increased by 10,000%. Like it's an exaggeration, but I'm just saying like, and then it goes to 2,000. It keeps so like the gearing to the price is significant, and I think that's why a lot of people are investing into or why the miners in this space can also do well when the price of the underlying goes up. But yeah. I think that right now there are increasingly more options to get exposure just to the underlying, whereas maybe there weren't before, right? Now, like just one final point on that, like using gold as an example, a lot of people are saying, or at least I've heard this argument that, well, when a Bitcoin ETF gets approved, people will be less likely to go open their Coinbase account and buy Bitcoin directly because they can own it through the ETF. And the most interesting data I saw, and we'll pull it and put it in the description for this episode, was actually with gold. Like when the gold ETF was approved, the gold ETF gathered a lot of assets, but gold investing, like self-custody and investing by other means, also increased as well, because what happened was the pie grew. The whole addressable market, or like the whole demand side for the asset class, grew because the ETF was a very big validation of that. And I think that the same thing could happen here, right? Where an ETF gathers billions of dollars of assets, hypothetically, and everyone else says, wow, Bitcoin is an investable asset just like gold, and we're going to own it in other means, right? And so everything kind of does well as a result.
Yeah, and also, guess who is going to be the custodian for all of that Bitcoin?
Yeah, Coinbase. That's why. Yeah, I mean, it's like, and like, listen, fees on custody are not going to be huge for BlackRock. Like, I don't know what they're going to. I'm sure they have a very sweetheart deal with Coinbase, but like, you're sitting on all this capital. Like you can lend the stock, the Bitcoin, if they want to do that. You can provide prime brokerage services on top of it. You can do trading execution, trading and redeeming. Like once you have the custody client, there's so much other cross-selling that can occur. And it's natural because they need the access to those services, right? Anyway, so all this stuff, like I'm not convinced any of it is really priced in at this point.
No, I don't think so at all. Coinbase, just a couple stats. Coinbase is actually down about 13% from when it made its high, or like a recent high in July. It looks like July 19th. Since then, Bitcoin is up over 35%. And that doesn't even take into account that in that time period, Base launched. And just to give you some stats on Base, if you're not sort of familiar, it's an optimistic roll-up L2. It has almost 10% of the TVL of Arbitrum, for example. Yeah. And Arbitrum is currently valued at $11 billion. So you could make the argument that Base effectively is a full $1 billion of value has been essentially added to Coinbase. And it's not even like these are just crazy valuations. Like L2s do make quite a bit of money. Essentially, it's almost like a surcharge on gas fees when you use an L2. That's like essentially the business model. And if we get a bull market, and when gas fees go up, the amount of money that these L2s will make, will go up, as well as the fact that higher gas fees on Ethereum will shift more and more users to L2. So it's pretty crazy that they just kind of spawned. Just in the last 6 months, a project that you could kind of argue is like a unicorn itself. And I also just think Brian Armstrong, is one of the best sort of CeFi crypto leaders in the space. And he's still the founder and still operating, which is pretty rare for a company that's 10 years into crypto. Typically, the sector has quite a bit of burnout. So. I just think it's a pretty attractive catch-up asset as well. But
well, let's move on. Just I want to cover one more topic, which is that one of the themes more on the fundamental side that we've talked about is like L2, so networks built on top of Ethereum that help to scale the network versus alternative layer ones, so like Solana, which try to do things cheaper, better, faster. And then we've also talked about the application chain thesis, right? Which is the idea that individual applications will actually launch their own blockchains. And the biggest sort of proponent of that or enabler of that is the Cosmos network. And recently, DYDX, a big exchange, has launched as an app chain on Cosmos. Have you been tracking this?
Yeah, I've been actually tracking it quite closely. Obviously, we built our own application chain. We used Polygon Edge, which is kind of like Polygon's version of Cosmos SDK. And if I was to give it kind of like a one sentence summary.
Right.
And it's actually really interesting because, so I think about this in two ways. So what's happening right now is first there's a lot of applications are looking to upgrade themselves by becoming their own, building out their own infrastructure so that they have control. So DYDX is a great example of this. You're also seeing some alternative layer ones become L2s. So OKX, for example, just announced that they're going to be converting, or they're going to be launching a Polygon CDK L2, which is essentially like a ZK EVM, without getting sort of too much into it, but essentially is an L2 built using Polygon's sort of ZK tech. And what's also interesting, just to kind of bring it full circle, is Canto, which is kind of like one of the more successful Cosmos app chains. They are actually in the process of converting from a Cosmos app chain into a Polygon CDK L2 as well. So it's kind of all over the place because DYDX is currently on an L2 and they're shifting to their own application chain. They were on Starknet before, which is not their own L2, but it's interesting to see. Like everyone's kind of going all over the place. I think more broadly, it really depends what your application needs. So if you're trying to be kind of like a generic ecosystem, so what I mean by that is you want all use cases, you're not sort of specifically tailored to one, then I think an L2 makes a lot more sense because there's a lot more security. You have like different security guarantees with an L2 than you have with like an application chain. But if you're sort of trying to build out a very specific ecosystem, then an app chain I think makes a lot more sense because you have more control. You have sovereignty over your sort of gas cost or transaction fees on the network. And so what we're sort of seeing is sort of the mad shuffle that's happening right now is I think that process playing out. So to go back to my examples, Canto and OKX, for example, they're not building specific application chains. They're trying to build kind of like, I don't want to say generic because that sounds bad, but like a more general approach to their ecosystem building. So it makes a lot of sense that they would find an L2 to be a better use for them. Whereas DYDX, which is, narrowly focused on becoming the biggest decentralized derivatives exchange, they're building their own application chain because using Cosmos, because it just makes a lot of sense there too. So I guess just to kind of bring it full circle, I think if you're building for a specific use case, an application chain makes a lot of sense. And if you're building sort of a more general ecosystem, then an L2 makes sense because then you can plug into Ethereum security model, but you can also plug into their sort of distribution.
Interesting. Oh, that's a very good summary. I don't think we've ever quite articulated it that way. And I say we, and I mean you. But yeah, that was very helpful, Andrew. Well, we'll keep an eye on that. I think this is sort of a big thing. There's another bit of news in the Cosmos ecosystem, which is that Cosmos just got USDC, and that's via an integration with a company called Noble. And they've gathered quite a bit of money, like $20 million or something. I don't know the exact figure. in U.S. circulating supply. That's obviously like a very important component of chain utility, is having U.S. dollar liquidity. So that's something that I think is worth keeping an eye on as well. We've had Yelena Jurek from the CEO of Noble on this podcast just before she launched. So you can go back and check out that episode and 120 other episodes that we've done. Some have aged well, others like a carton of milk. But overall, I think we've got a lot right on this show. So there's tons of great conversations with founders if you want to go back and check out the archives.
Yeah, I think one last thing before we go. I talked to the Noble team recently again. I actually think Noble is secretly one of the biggest sort of catalysts for Cosmos.
Yeah.
Because Cosmos, the sort of token itself, because Cosmos has always had this massive, it's an incredible tech, but it doesn't really have any value accrual to the underlying Cosmos token, or Atom token, I should say.
Yeah.
And what's interesting though is if you add, by adding sort of USDC into the mix, which then can now be, it's actually really, Noble's quite a, in my opinion, quite a brilliant project. It essentially, anyone who launches their own Cosmos chain now has access to native USDC through IBC, because of Noble. So, so what that means is there's like no bridging risk essentially when you launch your own Cosmos chain with the USDC itself, which is quite a bit different than if you launch kind of like an app chain, just like and you bridge it in USDC. And what's interesting though is it also makes IBC more, in my opinion, more sort of valuable and more important because it's now kind of the home of native USDC, which can't really, in a way, sort of exist without it. And so it's like, in my opinion, it sort of increases the need for like the IBC hub, which is, and also kind of because Noble's using Cosmos or Cosmos shared security, which obviously also has sort of economics for the Atom token, then I just think it's actually secretly like a potential huge catalyst for the Atom token itself, and sort of makes the hub, incredibly valuable and also sort of value generating as well. So yeah, I'm pretty excited about it. I mean, we're both Atom bag holders, so it's been interesting to learn more about the ecosystem and sort of understand how it works. And we should get when the Noble team hits 100 million in TVL, we should get them back for another interview to learn more. Yeah,
well, that could be very soon. Who knows? Thanks, Andrew. That was a great summary of what's going on in the Cosmos ecosystem today, and a great conversation overall. Wow, we covered a lot of ground. Equities, crypto, layer twos, Appchains, you name it. We got something for everyone here on DeFi Decoded. That's it for this week. We will see everyone next week. Until then, take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.